I'm sure that a lot of you already know Toby and Garrett and Greg. A lot of you probably know Greg through the Burge Center and through his involvement directly with CFAI. But wanted to give you a quick rundown of the calendar. We've got a number of events coming up over the next few months. Next event on the docket is going to be March 15th. It's going to be ESG investing in Asia. We're going to have a portfolio manager from Matthews Asia. So one of the areas where ESG really does come into importance, does affect returns. March 17th, we're going to have a financial planning speaker, Dr. Wade Pfau. For those of you who do financial planning, you're probably familiar with him. I've got a partner who's a CFP who described him as the Jeremy Siegel of financial planning. So I think we should have good attendance at that one. That's going to be a breakfast here on March 17th. Also going to have a program on regional private equity. We're going to have Blair Richardson from Bow River Capital Management. Should be a real interesting speaker. Prior to starting Bow River, he was the president of Morgan Stanley Japan, vice president of Morgan Stanley Asia. He's been doing regional private equity throughout Canada and the western region of the United States for the last 20 years. That one's also going to be here at DCC on April 18th. We're also going to have a career event. It's going to address people at all stages of their career. We're going to have a career coach, a LinkedIn speaker, and we're also going to have a photographer here taking headshots for your LinkedIn profiles. That's going to be on the afternoon of April 27th. Also a dinner on May 4th on Smart Beta. We're going to have the former head of iShares ETFs, Mark Harbour, who's now with AQR Capital, along with speakers from JP Morgan and the head of indexing at Northern Trust FlexShares. And that is going to be a dinner program on the 4th of May. And then, of course, the annual members meeting on June 8th. But we'll get on with the program, and I'll let Toby and Garrett introduce themselves.
Excellent. Thanks a lot, Dan. We definitely appreciate the opportunity to come speak to you guys. We'll keep this somewhat quick and easy, and then happy to answer any questions at the end of the presentation. We'll give the background on who we are and who Braddock is, go through the basics of structured finance, just how a trust works, along with why we think it's a unique area. And then we'll hit on some of the strengths of the opportunity today, which is the economic environment and also the changes that we've seen in the industry since the crisis. And then just hit the opportunity set. And there's limitless types of bonds we can show you. We grabbed 12 or so, and we'll show you those, and then happy to answer any questions after in the future. So Braddock Financial is a registered investment advisor since 1998. Actually did it before there was pressure to do so. It was established in 1995 by Harvey Allen, who some of you might know from the community, really to manage vehicles that focus on non-agency RMBS and other structured finance bonds, be that CLOs, ABS. Harvey's done a lot in the Denver community. Some of you might have been down to our Navy SEALs event that we're one of the main sponsors on at XJet Hangar. It's been a lot of fun and a place to work. He's a great guy. Right now we're managing private funds, mutual fund, and separately managed accounts. If you look back at the fund since the beginning, we've managed about $1.5 billion in 15 different vehicles. Many of these vehicles had more of a private equity type of structure with a limited life, and a few of them have been more perpetual in nature. We also have Braddock's holding company, which is our private equity type arm, but all of the businesses that it is invested in were operating companies that are related to residential real estate. And we really thought this was important because in our space you want to know what's happening at the Main Street level all the way up through the Wall Street level. And so we've had companies that originate loans, so we understand how that's working from agency loans down to hard money loans. We've had a firm that did loan level database, so it basically collected monthly mortgage performance, and that way we could identify, hey, who is paying their mortgage, who isn't paying their mortgage, and which types of loans perform better than others, areas of the countries, etc. We also owned a firm that did real estate owned disposition. So during the crisis, when a lot of banks were foreclosing on homes, bringing those houses back on their balance sheet, they needed someone to clean up the houses and sell them. And these were very helpful for us to understand what the discount there was when you had to sell a distressed property. Most of those companies we don't own today. We sold the loan level database company to Moody's Analytics, an arm of Moody's, the credit rating agency, and we sold the PMH, the REO disposition firm, to Stewart Title. The team at Braddock, we're a small firm but deep. Harvey was the desk head at the RMBS desk at Nomura back in the 90s, has been in the industry since the 80s. Our CFO, Tom Plisco, worked at Goldman. And the person that Ken Glickstein runs our private equity arm, and he came from Solomon City. You've got the portfolio management team today. It's Toby and myself. I've been a CFA since the early 2000s. Actually started my career in Denver in the early 90s with ING Investment Management as an RMBS analyst. A few years later, went back, got my MBA at Texas, and then spent 5 years as a commodity trader, trading natural gas and electricity. Was lucky enough to get the opportunity to come to Braddock in 2003. Took over running the desk in 2008. And I really focus on the RMBS side of the business and just all of our research related to that. Toby?
Good afternoon, I'm Toby Giordano. It's good to see some familiar faces here. Thank you for coming. And I'm a portfolio manager with on Braddock's funds as well as separately managed accounts. Joined Braddock in 2005. Lead the firm's effort in ABS and CLO research and management. Prior to joining the company, I was with Great West Life, an annuity here in town, where I was responsible for assisting in the management of the general account, which encompassed going across the structured finance industry, but primarily focused on non-agency, RMBS, ABS, and CLOs. And when I joined Great West in '96. So I've been floating around the structured finance market for a while.
So big picture, structured finance, we really like it today. We think it's somewhat unique in the fixed income market. I mean, when you think about the asset class, it's historically been institutional investors, banks, life insurance companies. There has been some hedge funds. I think when Braddock was first running private funds in the late 90s, there wasn't many hedge funds in the space, but that's changed over time. Part of the reason the amount of people doing it is small is that the skill set is, and the systems required are somewhat complex and costly. The securities, the thing that's really attractive about them is that they do have a wide variety of coupon, yield, duration, weighted average life. That seems to be very attractive with the institutional investors. We also like the space a lot today, not because we're a believer that interest rates are going to be rising quickly anytime soon, or for the last 5 years that the forward curve's been wrong. But we do think, hey, it's nice to be in something that as rates go up, which they will over time, our funds will continue to do well. When you look at traditional fixed income, there's no doubt that our space gives you a little more yield on a relative value basis. The durations are a little shorter. We like that. And I think if you look at our portfolio, especially since the crisis, we've shown that. We've shown low volatility, low correlation when compared to high yield bonds, equities. And I think those correlations really have been kind of 0 to 25%, depending on which indice you're looking at. Another great thing about the environment today is that we don't really need the growth of the U.S. to be 4% or equities to return 11% for our products to perform the way they're designed to do and forecast to do. If we stay around 2% GDP, that's fine. What we need is people that are able to repay their debts. And we see a lot of reasons why they can do that right now.
The next few slides that we'll take you through is really just an introduction to the structured finance market. Everybody in here obviously has received their CFA designation and has been at least studied or involved somewhat in the structured finance market through their studies, but We thought we'd just kind of go over a high level for those that need the introduction or need to revisit the space. But the structured finance market and securitization began in the 70s and has really grown into what's now a $1 trillion market. Securitization creates a diversified and tradable debt from large pools of what otherwise would probably be less diversified and less liquid assets. Businesses use securitization to realize the value of cash-producing assets. It enables businesses to access term financing across diverse sources of capital. And of course, those capital in our space could be hedge funds and money managers, as Garrett has mentioned, but more importantly, the institutional investors is deep in the space and has large participation across the market. These would be real money accounts, like the banks, the pension funds, the insurance companies. And these institutions will use the securitization to buy bonds because they break out specific risks on their investment strategy. For example, the insurance company, as we know, employs an asset liability management strategy. You know, here the insurer purchases a 10-year fixed rate investment grade bond to match that 10-year liability that's created against its policies. Securitization, going back to the 70s in its infancy, really formed out of the agency market, Ginnie Mae's, and then more into your traditional agency market. We bring that distinction up because as that developed and what we do now, and Garrett will probably talk more about that, is to make that distinction between the agency paper of mortgage-backed securities and then more what we do on a day-to-day basis, which is the non-agency or what we call private label space, where originators are originating those loans outside of the agency limits and then securitizing those. In addition to the mortgage market, of course, the securities are also backed by a variety of other cash producing assets, and those, we've listed here just a few, but commercial real estate loans, senior secured bank loans, credit cards, business receivables, student loans, autos, and personal consumer loans. In the securitization process, on this slide, we just want to show you that this is an example of the mortgage-backed securitization, and the loan originator sells the mortgages, such as a pool of first lien mortgages, to the trust. And the trust is a bankruptcy remote legal entity whereby the assets, the mortgages in this case, are held for the benefit of investors, the purchaser of the bonds, which is on the right side of this slide. So we have the underlying collateral on the left side that's sold into the trust. It's cash flowing assets, first lien mortgages, and on the right side we're showing the example of a residential mortgage-backed security and those bonds offered. The senior bonds, this is how they will cut up the capital structure. The senior bonds, of course, AAA rated. Many institutions utilize these, and this is where they can really tranche out specific needs and risks and cash flow profiles for their investment strategy. For example, on the AAA side of the senior bonds, we may have regular sequential bonds that are being paid, but as well as the IOs, POs that are utilized by institutions, non-accelerated securities that help more specifically time when you receive principal back to meet your liabilities that you may have. And then, of course, following that's the mezzanine bonds, AA through BBB, and then below investment grade, which is the sub-debt and equity on the capital structure. Now, the bonds issued through the trust are backed by the cash flow of the pool mortgages. The principal and interest, is paid sequentially from the highest bond at the top part of the structure, the AAA, to the lowest rated in the capital structure. That's good. On this slide, we wanted to show more of the capital structure and support that you find in these structures that backs the pool of cash flowing assets. Investors in these bonds enjoy benefits and diversification of the pool by geographic location, by borrower, by loan originator. But in addition to that, the structure here that you're looking at creates bonds with the different levels of credit risk. The credit risk here is depicted by one, the credit rating, which you can see on the AAA, and the mezzanine bonds AA through BBB, and the equity subdebt non-rated, as well as the credit support. That is the percentage on the right side of the graph that's associated with that rating. The credit support refers to a percentage of the trust below a specific bond. So the principal of the bonds with the higher levels of credit support is more secure than those below it. In this example, loan losses over the life of the trust will have to be above those certain percentages before that specific bond takes $1 of principal loss. All of the losses from the related pool here from defaulted loans are allocated from the bottom of the capital structure to the top. In this example, the BBB rated bond, for example, has 2% of credit support. And this, in summary, just means the equity will have to take the first 1% of losses, and then the BB bond will take the next 1% before the BB bond would experience any amount of principal right there.
It's important to realize that, the 2%, for example, of BBB is total losses, and these are asset-backed securities. So you're not going to usually take 100% loss on a loan. So you're going to need a multiple of that percentage of total losses or defaults before you hit that line.
As Garrett alluded to earlier, we currently find ourselves in an attractive investing environment for structured finance. In this current investing environment, we have various factors present that provide positive backdrop to the fundamentals of the space. And those would include the consumer, the current housing market, and the loan underwriting standards present today. I'll just tap the consumer slide here, and then Garrett will speak a little bit more to the housing market and the stringent underwriting standards that we see. So the U.S. consumer, the conditions are positive as we see it. There's a lot of health in the consumer. It's over 5 years. Over the past 5 years, we've basically seen a lower levered U.S. borrower, and they've created additional savings. We've seen increases in employment that have helped the consumer in both incomes and through their confidence. Obviously, the biggest example here is our unemployment rate has gone down from 10% over that time period to 5%. More recently, consumers are certainly enjoying the rewards of energy savings, and the strengthening U.S. dollar has made importing purchases and a lot more products and services more affordable to the U.S. consumer. And we see this in some of the 2015 statistics that we've put up here. Consumer spending was up 3.1% for the year. Consumers spent roughly 70% of their incremental disposable income. And then the middle point there, just to highlight, the savings rate has increased almost to 5.5% from where we were at the start of the year at 4.7%. Thus far, the consumer savings have largely been utilized by consumers to pay down their debt, improving their creditworthiness. Looking forward, consumers may use the cost savings towards more consumption, as we see it, or paying down additional debt. Either way, further benefiting the economy. And the main point we just want to drive home here is, during these past 5 years, the U.S. economy and the ability of the borrowers to perform on their debt obligations has steadily improved. And this is going to benefit many of the structured finance securities.
So looking at the housing side, so after people quit buying flat screen TVs, cheap clothes at H&M, housing prices started to recover in 2012. And we've seen years where they've been up, over 10%, years in that 5 to 7% range. But we really believe in the near term, 3, 5, 6 years, things are going to go back to historical norms, which for us would be that low to mid single digits at a rate similar to that of inflation. We have seen in the statistics, existing home sales, 5 million units a year, that's back to historical norms. But we haven't really seen that on the new home side. That is still lower than it has historically been, and that is because we are still working through a shadow inventory of homes from the crisis. It's probably 3 million homes in primarily judicial states, Florida, New York, New Jersey, but it's a competing product to the home builders. When we look at that historical downturn in prices during the crisis, it was very unusual. I mean, you can find house price history going back a very long time, but not really good numbers until probably the mid-60s. And you didn't see from the mid-60s until the crisis a national downturn. You always saw regional economic type of events. So the oil crisis in Texas in the late 80s, or the defense industry in Southern California in the early 90s. And we think that's going to be the more normal path for housing here, maybe for the rest of my career. And so right now, is Southern Texas going to have some issues? They might. North Dakota is definitely going to have some issues, and these are oil and gas related. Looking more at just the statistics, that support how much better things have gotten in the last 4 or 5 years. Fannie Mae seriously delinquency rate is 1.55, down from about 6% back in 2008. What we track a lot, we see in the private label deals, is delinquencies have just continued to fall steadily since 2011. You can use Case-Shiller and look at the 20 largest MSAs or cities and see that we've recovered a lot of that home price devaluation. We're about 12% below the peak from being down 35%. It's important to know that's just an index, so even if we can get back to those levels, just due to changes in inflation and the dollar and whatnot, houses won't be as expensive as they were at that point. Going back a little bit to the consumer and tying it into housing, we just see household debt and disposable income at the lowest level since 2002. And once again, that goes to borrowers who are not over-levered, borrowers who can afford to pay back their debt. So digging into this a little bit more, so someone like American Homes for Rent or REIT has gone out there, bought 17,000 properties, and they just take 3,000 properties, put them in the rental revenues from those properties as a cash flow into the trust. And then if for some reason those rents were to stop being paid, if they had enough people, high enough vacancy, the trust can go back, take the house, liquidate the house to pay the debt. But what we've seen there is, that the rental market's done great. We're seeing very good cash flow. See a lot of built-in home price appreciation in those deals. So that's been an interesting area. Obviously, a big topic lately has been the senior secured bank debt, which backs CLOs. And then, as Toby was mentioning, the kind of consumer marketplace loans are kind of a newer space that we're watching. Just to hit on the top there, on the RMBS related products, so the rentals, the legacy paper, really seeing yields in the 3 to 7% range for most products. A lot of what you're seeing there is, hey, do you need a money good asset or not? So those first two bonds tend to be money good assets where you're a first or second pay. The next two examples, the senior non-investment grade, tend to be more deals that originated with the worst quality loans from 06 and 07. So what used to be a AAA is now CCC is taking write-downs. It will never get upgraded, but some people really like those assets because they have a nice steady cash flow, and as we mentioned, they're somewhat easy to forecast going forward. An exciting area for most people in our space has been these GSE risk transfer deals. So this is new because forever when you said agency loan, you said, well, that's Fannie or Freddie or Ginnie, and I'm taking interest rate risk only. Well, now both Fannie and Freddie offer deals where you're taking some of the credit risk. And they're basically selling mezzanine bonds in a first loss piece. I just happened to show the first and second pay from a Fannie deal here. And those are those just incredibly clean mortgages that I mentioned earlier with the very high FICOs and a lot of money down. Already went through the single family rentals, and I'll let Toby hit a little bit on the CLO and ABS.
Sure, thanks, Garrett. The CLO market, I guess what I would highlight here, and certainly we can get into a lot of reasons why spreads have gapped out to as far as they've been since 2011, 2012. But, you know, I do want to, I guess, just earmark or point out the attractiveness of the CLO1 space, which is the first two on the BBB or BB bonds. And those are pre-crisis originated deals. They're past their reinvestment period, so the trust can no longer reinvest principal that comes in back into new senior secured bank debt. Instead, that's coming down to de-lever the trust and reduce the AAAs, which what it's done is provided more credit support to those bonds that lower in the capital structure. The BBBs and BBs are areas where, because of the increased credit support and the building of the credit support, the rating agencies take a look at them and value those as potential upgrade candidates. But again, you can find, just because of the CLO market right now, wider spreads, you know, 5 to 7.5 type yields on lower duration assets of just under 3 years that will continue to roll down the credit curve. You know, the CLO2 space is those that have been originated post-crisis. Certainly we can talk a little bit more again why the spreads are widened, but it's now providing, I guess, an interesting look, an opportunity at this point, as wide as the spreads have got when you start to price in some of the commodity exposure, which is lower in these deals versus the high yield market, and then the fundamentals behind the structure itself, and certainly selecting different parts of the capital structure of providing opportunity for us. You know, more like single A, for example, will have 17% subordination, where you're looking at historically bank debt default rates that have averaged 3%, and upon default have recovery levels that can get into the 70s. The bottom part, just ABS, we're looking into that as a new sector. Again, that was our marketplace lending. We showed it on the pie chart. This is the peer-to-peer lending, automated lending. This is where specialty finance companies are coming into the market now and originating where the traditional banks don't. And there is a good borrower there that we feel is underserved and can be underwritten. And more importantly, we're looking at the bottom part of these structures and the net losses, but I'd say in the near term, the originators that come to market are new and don't get a rating, and the senior bond at the top part of the capital structure right now can provide yields of 5.5, coupons of 5, on really a duration of less than 1.5 years. It's very attractive because these deals, again, as I mentioned, have that are very structurally protected, and if there's any deterioration and cumulative losses come in faster, there's triggers, very tight triggers involved that will then direct all the cash flow to that senior bond and help that de-lever, again, roll down the credit curve and become very short-dated.
So overall, what we've seen is obviously a lot of stress in the financial markets, which we haven't seen directly roll over into the performance of many of the loans in our space. Like I said, most of the consumer-backed loans, be them the merchant place lending to housing debt, have performed excellent. And then, you know, like I said, I think we've been very cautious with the CLO space, and I think we started 2015 with, you know, probably 40% of the portfolio in CLOs, and, you know, luckily by the end of the year we were below 15%, and the way things have gone recently, that was a good decision. So there is that rollover on the corporate side. But we're really just excited about the space. Don't see any reason for it not to do well over the next, really 3 to 7 years. We're happy to answer any questions anyone has.
You knew it was coming. I mean, obviously, there's some very attractive yields on the screen you showed here. I would argue that some of the outsized returns here are due to liquidity premium. And as investment managers, we've had to deal with that in a much larger degree over the last few years. How do you guys look at the liquidity premium and manage your portfolio to make sure you have enough liquidity for potential withdrawals?
Absolutely. John's absolutely right. When you look at our space and some of the spreads, they don't really make sense for the amount of credit risk you're taking, and that is driven by what happened in the crisis and what's happening now and what the rating agencies will do. So when we're looking at something that doesn't have a rating, you're really shrinking the size of potential investors. So I really look at our portfolios that we manage and say, okay, what is our illiquid bucket? And we need to keep that in that kind of 10% type of range, and tend to use that as more of the higher yielding assets. And then you got to look and say, what do we know has the most interest? And we spend a lot of time looking at markets where we can see a bid in the market every day. And that's one of the reasons that we like the new credit risk transfer deals, that we like some of the single family deals, because you've got 4 or 5 primary dealers where I can pop open a Bloomberg 3 or 4 times a day, and if I want to sell it, I can just sell it. On the legacy space, you like that these assets from pre-crisis have high cash flow yields. They really have cash flow yields anywhere from single digits up to 30%, but a lot of them are right in that high teens. So you kind of know you're getting this monthly cash flow to help you. And then you look at those and say, which ones do have investment grade ratings? For us, we keep, it's probably about 20-25% of assets where we say, hey, this is a very liquid asset, it's in demand because it's investment grade, cash flow yield is high, where we can see a bit, an instant bid in the market for it. Sir?
Oh, sorry.
Are you on the CLO?
Yeah, I was just going to add that, John, I think that's probably the most difficult challenge we have in our jobs in the structured finance market. And what a lot of you said is you want to capture that liquidity premium, and I think on entry point of the bond, you got to know your exit point. As Garrett mentioned before, we always look at things as horizon period returns, and when are we going to enter that? And part of that is where you're investing on the capital structure and in what asset class. What is the breadth and the depth of the market there? Are the hedge funds involved or are they out? And certainly in the CLO market, we saw that. We can talk all day about the structural protection, but to catch and sell out before the spread widening, you had low commodity exposure in CLOs versus high yield. The Fed not moving on the interest rate then moved a lot of people, inflows from the leveraged loan market into the high yield for a month in October, which just further depressed the loan prices and the loan indices. So it's kind of reading the breadth and depth of the market, who's in there. Right around that period in CLOs, insurance companies in the BBB tranche, which are typically all buy and hold, and have always stayed buy and hold and stay in there in the long term, while those guys left. So you definitely saw the spread widen because of that. And I think that's, again, that's the most important part of our job and something.
Recovery. You can look on this left graph, and that's just mortgage purchase applications. And you see it really came down, and then it's really been somewhat flat since 2010. And it's just in the last year that it looks like we're starting to see a little more new purchases of homes again. A little more increase in first-time buyers, less distressed sales, more traditional sales. I think when we look at that, we say, hey, that's increasing, and we know that underwriting standards are tight. So we believe there's some pent-up housing demand. But we don't think that's going to lead to over-exuberance in housing prices, because we know we have slow wage growth. We know we have slow interest rate increases over the future, and still need to work through some of that shadow inventory. So I think housing prices, will be somewhat tame. So just to give you an idea of why we specifically like our assets. First is the collateral. Here's just some graphs about newly issued loans. So one, I want to just make sure, and I think everybody knows this, that the products that were sold before the crisis, where you could say, hey, I valet cars in Vegas and make 150 grand a year, and then go get a loan for $400,000 or over. You can't go and get types of loans now where you can pay payments, less than an interest rate or interest-only type of payment. There are seems that that conservative nature, more of a traditional look at how underwriting standards should be, has come back, and you see that in that graph on the left. You see how loose the standards got. This is just the MCI index from the Mortgage Bankers Association. See a little bit of that historical norm and where we've been post-crisis. And you can see they haven't really loosened up yet. There's still probably people younger people, first-time home buyers, that have not been able to qualify for a mortgage yet. How does this translate? It translates into very low delinquencies. So that graph on the right, that dark line on the bottom there is prime loans from 2012. So borrowers like us in this room. You have a 750 FICO. You can put 25% down on your home. Your debt-to-income ratios are under 35%. You have 6 months cash reserves in the bank, et cetera, et cetera. People like this just don't default at a high rate. And so when you think about that slide we showed you earlier with the BBB bond with 2% credit enhancement, when you got 10 basis points of delinquencies 4 years into a deal, that's very attractive. I wanted to show you 2004 because we do think in 2004 underwriting was still done somewhat correctly. And you can see, kind of comparing collateral, that was around 80 basis points of delinquencies after 4 years. And we wouldn't have thought that was bad collateral. So today's collateral is excellent. We also do a lot of our business, of course, in the legacy deals, non-agency deals from before the crisis. And these have experienced just decreasing credit risk since the crisis. A lot of that is what we call credit burnout. So if you think about it, if you got a loan in 2006 and you were a good credit, there's a good chance you've prepaid out of that loan between then and now. So we see low prepayment rates going forward. It's easier to forecast that risk. Then you look at the higher credit risk loans in the pool, and you say, well, a lot of those defaulted during the crisis, right? When people lost their jobs, when they were over-levered. And then you look at who's left in the last few years, and most of these people, have shown they can, if you paid through that 5 or 6 years of the crisis, you've shown you can pay. So we see that roll to delinquency being much less. But even if you do roll into that delinquency bucket, nationally, loan servicers work with you. They were pressured by the government through the crisis to not kick people out of their homes. So you can get a loan modification that lowers your interest rate to something more reflective of today's rates, sometimes even below that. So just on this graph at the bottom, you can see, once again, people like ourselves, prime borrowers, that legacy pool of loans, about 17% are operating under a loan modification. And then you look at the blue line there, which is just defaults, and you see it peaked up at around 6% and has fallen down to 3%, and I think it'll continue to slowly trail down. I'll let Toby talk about the third aspect that we really like about our space right now, which is the actual structures and how they've changed.
Yeah, so we have the improved housing market factors. We're combining that with the strength of consumer balance sheets and the conservative loan underwriting standards. Again, these point to the positive fundamentals and collateral performance going forward and a lot of loans that secure the structured finance sector. What we want to hit on now is, even though this loan quality and expectation of loan quality is higher, the structured finance products and capital structures are now structured to be more robust than the capital structures that we saw in the pre-crisis cohorts. And so these approved capital structures have really been driven by, the investors, regulators overlooking the space, and the credit agencies involved in rating the bond. Consequently, the bonds are more protected from the loan defaults. And most often, the improvement in the robustness of the structure is seen in the credit support. These credit support levels, for example, in the prime RMBS deals, the residential mortgage-backed security deals, the AAA support has increased by 60%, which you can see from the 2005 on the right side of the slide and to the capital structure put together in 2015. And the BBB support that we've been using as an example has gone to that 2%, but an increase of about double. In the CLO market, the AAA and the BBB support increased by 40%. And this was really after the CLO market and securitization market was the lone survivor through the crisis. What we really saw is if people held on to their debt within those structures, all the investment grade rated bonds and very few of the BBs actually experienced a principal write-down if they just took it through that period. So even though we saw the structures work, the agency still increased credit support by 40%. In consumer ABS, what's been put out post-crisis has also been very attractive capital structures to the debt. And most of these will start with our first level of defense that we haven't really hit on in credit support yet, and that's excess interest. Just to define that real quick, on the pool of cash flowing assets that we have, you can have a weighted average coupon that those assets yield. And then sort of you take away the cost of debt from the liability side of the structure that was issued, the coupons that need to be paid out, and you get a net excess spread. And that's right there lies the deal economics to the trust. But that excess interest, instead of flowing out, yes, it goes to the issuer or the residual holder, but it can also be used as a first line of defense against loan defaults or losses that come through the trust. And in the consumer ABS space, it has other hard enhancement, such as reserve funds or subordination levels or over-collateralization. But most of the excess interest that you see built coming out of these structures has a multiple to the forecasted debt. So most of that net excess spread falls in the mid-teens area, where our expectations on the consumer, the unsecured consumer loan is around net average annualized net loss of 7%. So you almost have 1.5 times the 2 times protection there. So the bottom line is coming through this, the crisis, the robust structure nature of the capital structure. The loan originator has risk retention and more skin in the game, which you can see by the depicted, I guess, by the larger block of equity that's supporting the debt and capital structure. This slide, Garrett and I just wanted to show the opportunity set that's out there in the market, both with bonds and then just currently what's in the consumer market. What's being shown here is DBRS put this out, noting that the U.S. consumer lending market was over $2 trillion. This was in 2014. It's certainly of larger size today. But all of these loan originators are utilizing securitization to some point. We just wanted to show this to show the health in the market, certainly in the purchase mortgages and refi mortgage and autos and credit cards, but also in other growing opportunities that we see in marketplace lending, which is originators are starting to get over $1 billion on their balance sheets and starting to utilize the securitization market. In that process, creating additional opportunity for us.
So circling back, here's our table with just examples of some of the types of bonds that are out there in the market, what they yield. We always hit on this holding period return, because most of the time as an investor, you're not buying a bond to hold it for 30 years. kind of hit through the duration, interest rate, risk, the coupon type. The interesting thing about all of these products, and as we said, kind of what we used to call non-agency, now we really call more the private label. The mortgages can be a variety of different types of mortgages. They can be the new issue we've discussed or the legacy loans, but they can also be non-performing loans or re-performing loans. There's a whole new segment backed by single family.
You guys seen that as well, especially for some of the newer deals?
No, in the last couple of years? Yeah, really, the market traded very well. And there was many participants in the market, probably up till June of July of last year. So once we saw a lot of the technical factors that I didn't name, but you certainly had the growth in China. You certainly had some currency sets and global macro factors, weaker global demand. And then you started to see E&P guys default. Now again, in the high yield market, you have 17% energy, which is represented in most industries. In the CLO market, you know, the medium's 4%. And not all of those are E&P guys or sub-midstream guys, you know, so you can do a subsector dive and feel more comfortable, but, you know, contagion's there, right? It's, you know, so at that point, you know, when I said insurance companies started to get out, hedge funds started to get out, and that's where you see more of the illiquidity at the bottom part of the structures in the CLO market. And that's really has happened since, I'd say, the end of August. Definitely the end of September is when we saw a lot of market participants leave. And, you know, that's in that bottom part of the structure, the single Bs and double Bs, you know, there's, and again, this kind of goes back to John's question, why you have to follow and realize your entry point and when you want to move a bond, what investor is going to be there. And we do know at the bottom part of the CLO structure, you have liquidity until you don't. And that's what happened.
Well, and I would say, even at the investment grade, I mean, the triple B it's amazing how not liquid that is. I mean, if you look at our fund, I think our CLO exposure is around 10%, and that's pretty much all in our illiquid bucket.
Right.
You know, we put in reports that say, here's what's illiquid on a weekly basis, and that's what's there. And you do feel that because you don't have those concentrated. Where on the RMBS side or the single family or the new CRT deals, we can just, you know, most of that's reported in trace, so we can actually see the trade, the amount, the actual dollar. In the legacy space, you can see like products have traded, and you can really follow that. So that the CLO space is definitely very dicey.
Yeah, like I said, when the insurance companies went out of the triple B bond, we've seen them move, you know, from, you know, spread. They were trading as tight as, you know, 380 DM, and now they're out to, you know, 650 or a little higher. The top part of the structure still has plenty of liquidity. You know, you still have you still have more real money accounts up there, so you still see the AAA, the AA. Now they're trading at wider spreads, right? But you can find bids, you can find two ways in the market through Wall Street, all the way down to the single A. And then, you know, it's the most liquid bonds in the market right now are the CLO ones, which are the pre-crisis deals. And again, for reasons we already mentioned, they have the shorter duration and a lot of money managers. They have a lot of breadth and depth in the market.
Yes, sir.
Is there an active market for leveraging any of these asset classes, specifically at the junior part of the stacks?
You know, that's interesting. We don't have any financing on right now. And so I can't necessarily tell you how much that's changed in the last 3 months as things have been a little more dicey. I can say that, you know, historically, our fund before we converted, we had 7 lines open with pretty much all the primary dealers. Most were very happy to finance new issue deals, be it the new RMBS deals, the new credit risk transfers, anything really with an investment grade and new issue. Certain providers will loan against the legacy paper that is more secure. We did not, I don't know if they lend against the things that are triple C and are taking write-downs. We've never even asked. But I do think it's a time where in our space, a lot of hedge funds said, hey, yields have tightened in so much, the only way I'm going to make money is if I have more leverage on. And as people compete against them, we did much better than them last year because we didn't have the same amount of leverage on it. I do think ultimately in our space, if you, from a private fund basis, we didn't want to buy assets that you only make money if you borrow and really lever them up. You want to buy them because you really like the assets. And use leverage because you like them so much, maybe you want to buy a little more. In our space, when you look at these yields, these don't necessarily look like hedge fund type of yields. They're not 15%. But we think, like I said, from a relative value basis, we think they're pretty attractive numbers versus other traditional fixed income and where the equity markets are today.
So I mean, you guys lived through a black swan, right?
Correct.
Galena fund, redemptions, you had to kind of freeze and slowly unwind things. Can you tell us what that was like that year where it didn't take much, right? You guys were down 3% or something and suddenly everyone ran for the exits. Could it happen again in 5 years? How did you guys survive that?
Yes. Okay, so there's a couple things. One, I mean, is it going to happen again? As we talked about in this presentation, there's just not enough leverage in the system to cause that. There's not enough credit risk, and there's not enough even structures where bonds are being really sold at probably above fair value nature, and they're thin enough tranche where they can fall off a cliff. And so you don't have that same embedded risk. You also don't have just that underlying underwriting risk, where we saw, obviously, the one thing that really surprised me was that loan originators didn't change their behavior. I just kind of thought they were all as smart as everybody in this room, and if you originated loans all of 2006, and 12 months in, they were 10% of them were delinquent, that you would change what you do. But Countrywide did not, you know, and Bear Stearns did not. They just said, well, let's just keep the game going as long as we possibly can. And so we don't have that type of risk. If you're us from that standpoint, you're managing funds, you say, wow, the only good trade now is to be 100% short because you've marketed a fund that's long credit risk. So that was, I think, difficult for us. But what I really liked about our team is, you know, beginning of 2006, we were levered at basically a 50% loan to value. And by the beginning of 2007, we had no leverage on. By March of 2007, we had $400 million of long position in the Galena Street Fund, and we had $250 million of short position to hedge it. We still ended up closing the fund. You know, ultimately, Galena returned, I think, 85 cents on the dollar from the closing NAV. So we were, you know, proud of your performance as much as you can be when you lose money. You're not happy to lose money ever. But yeah, it was definitely a rough thing to go through, and it bothers you when you know that I don't think a lot of that would have happened if people would have had more information from the get-go.
And that's the thing, is you just knew that by freezing redemptions and just holding on to the stuff and selling it a year from now, everybody would be better off. So have you guys learned something about limiting the ability for people to leave a closed-end fund structure?
You know, I think I learned the opposite, which was if things get bad, sell it quickly. You know, waiting around and being wishful thinking. I mean, the bottom line is we can tell you all day that the CLO structure is going to work. But if I turn to Toby and he's got a CLO marked at 70 and I say, can it go to 20? And he says yes, then I should tell him to sell it. I mean, that's our job as portfolio managers and risk managers. And then when it gets to 20, you can buy back in. Then you look like a genius. It's much better than doing it the other way. And so, yeah, like I say, we look at most of this space right now, we see it more as something that, although the liquidity is not equities, there are definitely, you know, there's definitely good liquidity in several types of assets, and enough so where the yields, the relative value, and the liquidity match to make, I think, a more attractive public fund than a private fund right now.
Yeah, I think in the crisis, that's what we did well. Just the sum is just, took a look what did make sense, where we thought it could go, And sure, we utilize credit default swaps to help mitigate the downside in short positions, but what we did best was stop buying and started selling.
Any other questions? Well, thank you very much, and feel free to come have a show here.